Sooner or later, investors always get punished for performance chasing. And investors in dividend-focused mutual funds and ETFs may be in for such a punishment in the future. Today I'm going to cite a couple sources, one from Jason Zweig's Intelligent Investor column from the Wall Street Journal from early April, and also one from Vanguard. Why am I bringing this up about dividends? For three primary reasons. First is I've had a few people ask some questions, and the question comes from a good place, and it goes like this. Hey, shouldn't we be focusing more of our money invested in dividend-paying stocks? The second reason is that dividend-paying stocks have attracted, this is through April, $9 billion of net new assets year to date, while all other U.S. stock-centered funds have had net sell-offs or withdrawals of over $7 billion. Now, two reasons are cited for all this. The first is this low interest rate environment we're all very well aware of, so people are trying to find some income somewhere. And the second reason is stated as investors may be performance chasing. This is the sarcastic portion of the video. Do you think they might be chasing performance? You see, last year the top 100 stocks on the S&P 500 outperformed the overall market. I'm sorry, top 100 dividend-paying stocks, I correct myself, outperformed the overall market by 8 percentage points. Whenever you have an outperformance in any sector of the market, the next year you will see what we're seeing this year, which is the average investor lining up like lemmings and chasing that performance. Jason Zweig cautions to be careful about jumping on this bandwagon. You see, if you go back to the financial crisis from 2007, the top of the market, which is the end of 2007, to early 2009, you had the S&P 500 down 50%. The Dow Select Dividend Index was down 53%, so it actually had a little bit more volatility than even the overall market. But I know what some of you are thinking. And that is, hey, if the market's going to be down, it's nice to be getting some income while it's going down. Well, if someone had loaded up on the S&P 500 dividend-paying stocks in the end of 2007, those dividends were heavily centered on financial companies and automobile companies. What were the two areas that were at the heart of that financial crisis? Financial companies and automobile companies. So you had investors unwittingly lead themselves into a place of less diversification and a place where this income that they were after and many times was either reduced or suspended entirely. So it can have unintended consequences. Furthermore, the favorable tax treatment of dividends is on the bubble right now. Unless White House and the Congress acts next year, you're going to have taxes on dividends go from 15% to 43% for those in the top tax bracket. So they won't be nearly as favorable if that were to come to pass. So chasing performance is never good, ends up less diversified. We don't do it. Don't you do it. Until next time, thank you.